Let's bring in Lauren Saidel-Baker. She's an economist at ITR Economics. Lauren, thanks a lot for joining us. How much of a surprise is this to you? This is a third reading, but the numbers, particularly that headline number, significantly stronger than expected.
Yes, this is a great result. It is something of an upside surprise, but again, we've been seeing general stability in the U.S. economy, so I'm not too shocked by these numbers. Good to see further growth, and really what we're looking for is the underlying components for future growth leading into the fourth quarter, which we've now almost closed out, but certainly into 2025. Leading indicators are pointing up. The PCE data, as you mentioned, showing that the consumer is on very stable footing. We're still very healthy from a consumer spending point of view, which is what drives about 2/3 of GDP here in the United States. So I see this as a good signal for further growth to come.
How does this fit, if at all, with the guidance of the Fed yesterday that had such a dramatic impact on equity markets?
Yes, the Fed did cut again yesterday, and getting a lot of questions about how much these cuts are merited. Now, we at ITR Economics had been seeing building inflation by the tail end of 2025. That has been our base case view for quite some time now. We're starting to see markets come around to that expectation, partially on the potential for tariffs to be imposed. That does tend to be inflationary. But I want to be absolutely clear, tariffs are not the only thing that will likely cause higher inflation next year. We have a lot of fundamental drivers, really just a lot of liquidity out there in the marketplace. I think that will limit how deep into next year the Fed will be able to cut. We saw their guidance come down a bit with the dots plot that was released yesterday. So again, I think the motion is more toward the economy is doing quite well. We don't need to provide too much more stimulation with additional rate cuts. That means we might see a slightly higher base for rates this cycle.
And Lauren, if this strong economic data persists into 2025, do you think there's a chance that we may even have fewer than 2 cuts or maybe no cuts in 2025? I know there was some chatter in the market yesterday about that concept, and obviously something that probably wouldn't be welcomed by the equity market at least.
Absolutely not by the equity market. No, I think fewer than 2 cuts is absolutely on the table. I'll go a step further and say we might even see rate increases by the year end 2025. I don't think that is a completely outlandish position to take. Again, inflation is what the Fed is watching. Our labor market, the other half of their dual mandate, that is stable. Yes, it's showing some signs of easing up, but coming from just such a historically tight starting point, this is not something to be worried about on that grand historic view. So they've been burned by inflation in the very recent past. They really don't want to get burned by runaway inflation again. I think that is where the focus should be and will be in 2025.
What kind of setup would cause the Fed to actually increase rates later next year?
That would be inflation. Again, they really can't have inflation get away from them again. We hear so much still backward looking about this recent inflation cycle. It didn't turn out to be transitory. We still are getting some messaging from Fed officials, especially Chair Powell, about the potential for tariffs either to be more inflationary or for that to be, a little bit more transitory, right? A little bit more stable, just in terms of how inflation expectations are anchored. So this is something they're putting a lot of thought into. Again, we haven't seen any actual policy proposals from the incoming Trump administration. So it remains to be seen just what tariffs we will get, what percentage, what type, whether they're targeted countries or universal tariffs. Clearly, those would have very different implications for pricing overall. But that, to me, is the big wild card yet to come.
And Lauren, how are you thinking about this bifurcation we're sort of seeing in consumer behavior in the U.S. with the high-end consumer continuing to do very well and seeing, perhaps some signs of stress on the lower end? We've seen some of the, large retailers that sell to that lower-end consumer talk about, perhaps weakness here and there. And then we've seen, I think, credit card and auto loan delinquencies move up. And people have pointed that out as a potential, risk going into next year.
We absolutely see in this type of economic cycle that middle to upper income consumer is much more insulated from this inflation. The big driver to inflation costs recently, it's been shelter costs. So if you own your home, if you bought a home back when prices were lower, back when mortgage rates were lower, whether you bought then or refinanced, you're sitting in a very different inflationary position than someone who's either renting today or looking to be that first-time home buyer. So we are getting an absolute bifurcation here. here. And again, partially it is choices that we're making. So yes, delinquencies are creeping up, the total amount of credit card debt, right? We are putting more on plastic here in the United States, as we tend to do. We slip back into those old bad habits. But going forward, we do still see that stable labor market. Almost anyone who wants a job today can find one. So especially amongst those lower earners, we've seen wages increase to a higher percentage degree. So I'm not saying that the bottom is falling out from any segment of our population, but with these higher prices, with inflation being just so present in our thought patterns, we are making different choices, maybe trading down in quality, just looking for that value in different ways than we have in recent years.